Breaking news in the last hours, the Fed is on course as policymakers raised rates for a fourth and final time this year. They shrugged off a barrage of criticism from President Trump and increased volatility in the stock markets and a slight softening in economic growth forecast. 2.25 to 2.5% is now the Fed funds range. Whilst the Fed still believes some rate rises are needed, policymakers expect only 2 in 2019, one less than previously forecast. In a statement, the Fed said it is monitoring the global economy. Its exact words were, "We will continue to monitor global economic and financial developments and assess their implications on the economic outlook." That is a change from the last statement. A moment ago, Jerome Powell warned the Fed sees some signs that growth in the US is slowing.
Despite this robust economic backdrop and our expectation for healthy growth, we have seen developments that may signal some softening relative to what we were expecting a few months ago. Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year.
Markets gave up the earlier gains as the Fed decision was published. What's interesting about this is it was up as much as 382 points, and then at 213, but immediately after the actual, the market sort of stages a little mini rallyette and then falls out of bed. And we're now off the worst so far of the day. The Fed expects economies to soften. This has spooked investors. And if you look at commodity prices and copper and gold, they are also down, which is slightly unusual because obviously in uncertainty, then that is different. And arguably in times of inflation or higher inflation or slower economies, you might want gold as a hedge, but that doesn't seem to be the play at the moment. I'm guessing there's more behind all of this, which is why we have Mohamed El-Erian here to help us understand. First of all, what the Fed says is it's going to slow down.
It says it's going to somewhat slow down, but it came across more hawkish than the markets expected. And what you're getting now is a signal from markets. This is a policy mistake. And I think that's important. If you look at the turnaround in stocks, if you look at the lower yields, if you look at the flatter yield curve, all that is flashing, be careful, Fed, this may be a policy mistake.
So that's the hawkishness to stick to the 4th hike this year.
3 things. 1 is they deliver on a hike.
Yes.
That was expected. 2 is they reduced next year's rate hikes, not from 3 to 1, but 3 to 2. And 3 is they still are going to overshoot the equilibrium rate over in 2020. So the market is saying, wait a minute, that wasn't a dovish enough hike. We needed a more dovish hike.
So when you say a dovish hike, would that have been don't raise 4, but say you'll do 1 next year?
So,
or raise 4, raise the 4th and say 1 next year and give us some language. I guess what I'm trying to say is the 4th rate hike, was it inevitable because of the political pressure that if they hadn't, they'd have been in trouble?
Yes. It was inevitable. So I don't think the market expected them not to hike, but they expected them to signal a more dovish path from here. That is what they missed doing. Look, we have to understand, central banks have gone from being the only game in town where they can do no wrong to being in a lose-lose situation where they are today. And that is the new realities, and it's because we have over-relied on them and they simply cannot deliver now what they used to deliver.
What justifies what we're seeing now, where a market has gone from up 300 to down 450 to 490 points, with every prospect since we're in the last hour of this getting even worse?
It's what I call the concern about a policy mistake, that the Fed is going to hit the brakes too hard by hiking too much next year.
But if we accept that that there is an element of uncertainty about the strength of growth next year, how does a Fed, you're in touch with these people, how do they make that sort of mistake?
They make the mistake because they have to deliver too much. They simply cannot deliver what the market wants them to deliver. I think you have to think about this as a no-win situation. And it comes against the background that we're coming from a year, 2017, where investors had it all. They had high returns, they had low volatility, and the correlations were all in their favor. So this is just, in my view, a resetting to normal, but it's a pretty painful one if you're long this market.
It is almost inconceivable that we've gone from growth of 3.5% to 4% to where people are, reputable people, are talking of a recession next year. And it's not easy or obvious to see what's led to this.
So what's led to this is weaker Europe, weaker China, and concerns about spillbacks. That's what led. I don't buy the recession next year. Don't buy it.
But it's no different whether you're up 0.5% or down 0.5%. It's still going to feel very slow, very sluggish, and you may start to see unemployment going up.
I'm willing to take a bet that we'll see unemployment going down next year. That the issue is less the economic outlook and what we in the marketplace call technicals. That is people being overextended, the paradigm changing in China, in Europe, and suddenly everybody wants to get back on site at the same time.